Welcome, everyone, to this explainer. Today, we're breaking down one of the absolute most explosive and honestly most debated stock stories we've seen over the past year, Tower Semiconductor. Now, if you've been tracking the semiconductor space at Audit, you know AI has thrown the entire industry into overdrive. But Tower's recent trajectory, it stands out even in a booming sector. It really raises a critical question for us to answer today. Is this company a genuine AI pioneer that's just getting started, or is its stock currently priced for absolute perfection? Let's figure it out together.
Okay, here's our roadmap for the day. 1. The TSM stock surge. 2. How they're fueling the AI boom. 3. Their brand new financial model. 4. The bull case. And finally, 5. The bear case. Let's get right into it.
Section 1. The TSEM stock surge.
We really have to start with the sheer scale of what's happening here because this number is just staggering, 664%. Since hitting a low of $28 and change just about a year ago in April 2025, Tower's market cap has absolutely exploded, rocketing past $283 a share by May 2026. To put that into perspective, that is the kind of hypergrowth you'd expect from a pure software startup running out of a garage, right? Not a company that physically manufactures semiconductors in massive, multi-billion-dollar factories. And you know, this surge, it's backed by some very real, tangible momentum. Looking at their Q1 2026 headline numbers, revenue jumped 15% year over year to over $413 million. But what's even more impressive is their Q2 guidance. They are projecting $455 million, which is poised to be the highest quarterly revenue in the company's entire history. Plus, they just pulled in $290 million in customer prepayments in a single quarter. That right there tells us we aren't just looking at hype. We're looking at accelerating cash flows from customers who are literally paying hundreds of millions just to lock in their spot in line. Which brings us to Section 2, fueling the AI boom. So what's the actual catalyst behind all this growth? Well, as AI data centers scale up, they require absolutely unprecedented bandwidth. Traditional copper wiring, it just can't keep up anymore. Enter silicon photonics, or SiPho. Basically, this technology uses actual light, photons, instead of electrical signals to move massive amounts of data at lightning speed. Tower's SiPho chips, specifically the ones designed to support advanced NVIDIA networking protocols, are rapidly becoming essential to the physical infrastructure of AI. And it's fascinating to see how fast Tower is pivoting to capture this demand. Their revenue mix has shifted dramatically. The RF infrastructure segment, which is exactly where these high-value SiPho chips live, has actually doubled its contribution. It hit 32% of their total revenue by late 2025, completely overtaking their older legacy mobile segments. They are actively stepping back from lower-margin products so they can essentially sprint toward this AI-driven infrastructure demand. All right, moving on to Section 3, a new financial model. To actually meet this insatiable demand, Tower is completely rewriting its financial blueprint. By 2027 or 2028, their newly revised target business model is incredibly ambitious. They are aiming to push their built-out capacity to generate $2.84 billion in revenue as a run rate. But the real takeaway here is the profound operational leverage they're expecting. They are forecasting a 3.4 times multiplier on their net profit, targeting a massive $750 million. Now, to achieve those kinds of jumps, where incremental gross margins hit 59% and incremental net margins reach 42%, you have to spend money to make money. Tower is dumping nearly $1 billion, about $920 million to be precise, into capital expenditures across their multi-region fabs in the US, Israel, and Japan. They're basically transitioning right before our eyes from a solid, standard foundry into a high-margin specialty powerhouse. But honestly, the most fascinating part of all of this, they aren't just building these massive factories and crossing their fingers that customers show up. Over 70% of their total silicon photonics capacity is either already reserved or in the process of being reserved, all the way through 2028. Remember that $290 million in prepayments we talked about earlier? That is strategic customers securing their supply. It heavily de-risks Tower's billion-dollar capex gamble. So all of this incredible momentum sets up a really classic tension in the market. It's a fascinating clash of perspectives. On one hand, you have these aggressive growth narratives fueled by guaranteed customer cash. And on the other hand, you have strict traditional valuation fundamentals saying, whoa, hold on. So who's right? Let's start with Section 4, the bull case. First off, institutional confidence in Tower is incredibly visible right now. back in May 2026, S&P Global Ratings affirmed Tower's AIIA credit rating and officially upgraded their outlook from stable to positive. That is a massive stamp of approval on their operational performance and their super clean balance sheet, which, by the way, boasts over $1.2 billion in cash with virtually no crippling debt. For the bulls, the argument really revolves around this specific combination of facts. Analysts are projecting a staggering 44.5% annual earnings growth. And bulls argue this isn't just a pie-in-the-sky estimate, it's incredibly safe. Why? Because Tower already has $1.3 billion in contracted silicon photonics revenue lined up for 2027 from their largest customers. You combine that guaranteed cash with a global footprint that shields them from a lot of regional geopolitical risks, and you've got a seriously compelling recipe for sustained outperformance. But of course, there's always another side. Section 5, the bear case. The absolute loudest alarm bell for the critics is the valuation, specifically Tower's trailing price-to-earnings ratio, which hit a staggering 131.25 in May 2026. To give you some context on that, the broader U.S. semiconductor industry average is sitting right around 63. So Tower is trading at a massive, massive premium compared to the rest of the sector. And this premium becomes even more obvious when you compare them directly to their foundry peers. When you look at enterprise value to estimated 2027 sales, which is essentially what the whole business costs compared to what it's expected to bring in, Tower trades at a 6.5 multiple. Compare that to slower growing but highly established peers like GlobalFoundries at 2.8 or United Microelectronics at 3. The bears look at this and say, guys, you are paying an exorbitant software-like price for a heavy manufacturing company. And financial analysis platforms are definitely highlighting this severe disconnect. Discounted cash flow modeling, which tries to estimate the current value of all the future cash a company will ever make, puts Tower's fair value at roughly $165 a share. With the stock trading way up in the 280s, investors are basically paying for a flawless future. There's a very strong argument here that the current price has already entirely baked in all the upside of those 2028 targets. And that leads us to the core skeptical argument. There is absolutely zero margin for error. If Tower experiences even a slight delay in getting these new fabs qualified, if there's a supply chain hiccup, or if the broader AI data center build-out cools off even slightly, well, there is no valuation cushion left to absorb the shock. If you're buying at these levels, you are betting that Tower will execute a billion-dollar global expansion absolutely flawlessly. So, as we wrap up this explainer, we're looking at a company that is undeniably building the physical backbone of the AI boom. They're securing massive prepayments and they're completely upgrading their business model. But you have to ask yourself, does that guaranteed customer cash and technological edge actually justify this extreme valuation premium? Or is this a flawed story with a highly flawed price tag? Let me know what you think. Keep questioning the data, and I'll see you in the next explainer.